Okay, hello everyone and welcome back. My name is Greg Furman and this is the Vantage Point AI Market Outlook for the week of September the 30th, 2024. Now, to get started this week, we'll begin where we always do with that very important US dollar index where we have a very mixed signal here. Our MA diff cross, which is our medium-term strength, is rising against and has crossed over our long-term predicted difference, suggesting that the dollar is not quite done just yet. We're going into a rather data-heavy week. We've got the ADP report, I think, on Wednesday, then the non-farm payroll number on Friday. Now, if you get a slightly better number, that could change the Fed's path, but it's very unlikely. We are at 14-month lows on the dollar index. But again, the signals here from Vantage Point are somewhat flat. Our T-cross long has been containing the market. We have crossed over the yearly opening price, but we do know either way that the dollar is likely to sell off on its seasonal pattern in after the first week of October or after approximately October the 5th or so. That's usually it for dollar strength, and you still have small periods where the dollar rises, but the overall primary trend remains heavily down. So now with the Fed's rhetoric of more cuts, that's going to likely accelerate the move on the dollar, but I think we have one more bout of strength before we turn lower, and that's what the indicators in VP are currently saying. But again, I think that any retracement at this point will be back to our T-cross long at 100.99 or our yearly opening at 101.37, which is likely to contain the market. Now, when we look at the equity markets going into next week, the S&P 500, once again, very slow week here. So when we look at that, we'll do an accurate performance of the S&P 500, which directly relates to our SPY ETFs, etc. So the week was very soft at 0.49%. Now, when we look at this in the month of October, equities do usually fare, they do decent, I would say, but there is a lot of chatter about a recession in the US. I believe personally that they're covering it up, that they've already falsified the jobs numbers, missing a million jobs over the last year. We're in an election year also, so the information is not the best coming out of the media these days. But for now, I believe we will come down to our T-cross long. That's coming in at 56.50 next week. And I further believe that it can be challenged even lower than that. Now, when we look at the indicators, we have, again, an MA diff cross that has taken place on the S&P 500 on or about September the 19th. We have not had any significant gains since then. So once we establish this, and we've got the medium-term trend is weakening against the longer-term uptrend, we're slightly overbought on the predicted RSI, but that's not a determining factor, but the MA diff could be. So when we look at that, we want to make sure we're cross-referencing it to the inverse correlated VIX. The VIX, again, is gaining strength. We are above the quarterly opening, the monthly opening, the yearly opening, and now above our T-cross long at 1853. This is suggesting that their options in the options market, there's going to be less demand for them, and we are likely. I believe this to be a warning sign that the major indices and a number of stocks are getting ready to move lower. So right now you can see that the predicted RSI has broke the 60 level. There's momentum building in the VIX. So again, nothing is 100%, but the idea is to get out in front of these things because again, this is an outlook, not a recap of something that took place last week. We're forward thinking into next week's trading for the first week of October. So to do that, we want to look at these signals and say, look, should we be buying stocks, yes or no? The VIX is giving us a clear warning sign that something based around the correlation to 31 other markets is a little bit off in this stock market rally. Now, when we look at gold contracts, once again, gold advancing higher from last week, but again, when we come into a week of non-farm payroll number, there's going to be indecision in the market, and in most cases in that first week of the new month, gold isn't strong at all. So I can anticipate a pullback to our T-cross long at 25.90. We can reassess at that particular time, but you can see that the predictive indicators here are pointing down. We are losing momentum. Our medium-term and long-term strength Both are sloping downward. The predicted RSI is taking a hard drop from Friday. These are all warning signs. The VIX, gold, these are warning signs of some dollar strength here, and that would be normal on real dollar demand in the first week of the new month. But again, to be clear, in most cases, that's it for the dollar for the calendar year, and the bulk of the trade is down. Gold does very well in the latter part of approximately November, and does very well in December. So a pullback would be healthy, it would be normal, and that's what we would look for next week. Now, when we look at Bitcoin here going into trading continues to advance. Now, I've talked about the seasonal pattern in October for Bitcoin contracts, and that also goes towards anything related to blockchain, bit farms, Hut 8 mining, the different stocks. So if you don't like trading Bitcoin directly, then there are other ways to do it. And that's the basis of intermarket technical analysis, that we can say, okay, well, something as low as Bitfarm or Hut 8 mining or any other blockchain stock has a 95, 98% positive correlation to Bitcoin versus the US dollar. So if it goes up, all those individual stocks will likely follow. So right now, Bitcoin is looking pretty good, but I would anticipate some type of pullback coming this week, just on position adjusting ahead of that non-farm payroll number. Our T-cross long is 62,461. Longs are viable while above that area. And in most cases, Bitcoin does make a big move in the month of October. So I would be mindful and be patient and look for that entry point. But either way, in my respectful opinion, based on that seasonal patterns, the predictive indicators, we are likely moving higher. Now, light sweet crude oil for next week. Again, light sweet crude oil, just no buyers. This is why we use the current yearly opening price. When we see that rolling performance model of what something did in the last 5 days, 30 days, 60 days, those are random, subjective levels, guys. We want to make sure we're using the start of the calendar week, the start of the calendar month, the quarterly opening, and the yearly opening. So you can see that multiple fantastic short trades on the right off of that yearly opening price. The indicators from VP confirming right on that yearly opening price. You can see we have an MA diff cross here. The pink line crossing over the blue line, combining that with the yearly and the monthly opening price along with the T-cross long makes for a relatively easy trade, as money also pours into natural gas this past week. And I believe it will continue to move into natural gas as long as oil is showing this weakness. Now, I do have a reverse check mark here. That's a bit of a warning sign, but again, our retracement points are very clearly defined. That is our T-cross long at $70 a barrel, our current yearly opening price at $71.78, and we will get a new monthly opening price on Tuesday of this week, and that will be an area to watch also to gauge the dollar and the major markets. Now, with a very quick look at the European equity markets, they are actually, I would say they're on fire here, guys. They're really moving higher. I noticed this earlier in the week. The question is, can it continue to move higher if the S&P, the Dow, and potentially the NASDAQ drop? That's something we have to take into consideration. But for now, they do remain firm. My concern is the distance between where the market closed on Friday at 19,473 and our T-cross long at 18,815. So I believe we will retrace back to that level if the VIX has confirmed the signal that there's a problem with equities right now, buying those stock indexes and potentially individual stocks also. But this can be affected with your European markets. So watch that area very closely. But if there's any sign of a weakness up here, I would recommend, again, being very cautious with longs up here, because the DAX, even though it's the European equity markets, it's still susceptible to the US market weakness if that occurs. Now, when we look at some of our main forex pairs, starting with Euro US, the Euro completely stalling out this past week. Once again, it's very important that we look at these levels up here. We have a verified resistance high going back to August the 26th. That level 112.02, that has basically contained the market for over a month here, guys. We got slightly higher, 112.14, and then failed again, but we're also running, there's good long opportunities using that Vantage Point T-cross long predicted moving average. You can see like a moth to a flame, the market is drawn to it. That's your retracement point. This has nothing to do with Fibonacci or any of this stuff. It's this line here that tells us and says, okay, here's the predicted moving average that has a correlation of 31 other markets. So again, if we are going to break down below that T-cross long at 111.17, it would likely be in the next 5 to 7 days. And if that occurs, that would likely be a short-term move, barring any information from the ECB. But for now, the indicators are warning, the reverse from the dollar index, suggesting that there isn't a lot of momentum in buying this particular pair. And I don't think we will see that until after we get that labor report on Friday and see, okay, what is the Fed going to do next? So your T-cross long, that's your area to watch for next week. We have pretty good buying there, but we also have pretty good selling above 112. That's what we're dealing with going forward. Now, the US Swiss franc, once again, struggling this week. It's basically, you can see that we're trapped between the T-cross long, the monthly opening price, and then our yearly opening price at 84.10. In my respectful opinion only, by mid-October, we break down below 84.10 on dollar weakness and potentially safe haven flows into the Swiss franc also. But once we break down below that area, then you're likely going to have a much bigger trade going into year end. So watch for a break of 84.10. Once we get that, we're good to go. The indicators from VP are saying we're close to that now. So again, we'll watch these levels, and once we break down, shorts are heavily favored. Now, the pound dollar this past week and going forward, very similar to the euro-US pair, just simply stalling out here. This can be misinterpreted as dollar weakness, when in actual fact it's dollar strength that's not letting it go any higher than this. That is basically an indisputable fact that we have no buyers up here around 134.30. So for the start the week, put your line right across. You can see you have 4 bars that are sitting there. So that tells me that a retest of the T-cross long is actually, in my view, is likely imminent. So again, we will continue to watch that level, but we would need a breakdown, again, of that T-cross long at 132.47 to change the directional bias. You can see we're firmly opening, firmly above our yearly opening price. But one other thing to remember, guys, the quarterly opening price is going to change on us on Tuesday, and it's going to go from 126.39 to wherever we finish out or wherever we start in Tuesday's trading. And that is likely going to be somewhere up here around the 130. I'm going to guesstimate it, and probably around 133.50. So that's a very tall order now for the pound dollar to hold above that area. But right now, the indicators are saying we are going lower to start the week with the MA diff cross. When we look at the MA diff cross, we combine it with 4 bars there that are all stacked up against each other. And that, again, is a big warning for us to essentially be very careful with any kind of longs above 134. Now, with the dollar yen, there are some changes going on with the current government. Now, that change could bring, again, rate hikes into Japan. That's what he's talking about, the new leadership potentially. So the interest rate differential, either way, the dollar yen is grossly overvalued, even at 142. So if we can break down below 141.03, that will basically confirm that the carry trade is in a lot of trouble here, and so is the dollar against the yen. I believe this will be very, very good shorts in 2025 and going into the end of 2024. So watch for a breakdown of 141. But remember, if dollar yen breaks down, all your Japan cross pairs are going to follow. Euro Japan, Canada Japan, Aussie Japan. Problems right across the board as the yen strengthens on potential rate hikes. So very interesting. VP is picking up on that with our MA diff cross, our neural index strength. But this is currently showing downward momentum with the predicted RSI. But again, I believe we have to get through that payroll number first. But if we can hold below our T-cross long, that's coming in at about 143.55, then we should see additional shorts building on this particular pair as they exit the carry trade. Now, when we look at US Canadian, very little reason to be buying Canadian dollars for the most part, other than dollar weakness. And as you can see, we've got some verified resistance support here. And with that support, once again, we do have again, the Canadian dollar is could potentially come under pressure, not just from oil contracts, but a sell-off in the equity markets. And the fact that US Canada is rising while the equity markets are flat, that's another warning sign to be careful with stocks next week. So we've got a support low here at 134.30 on all this Fed rhetoric, etc. But we're still, the primary trend is still up, but while we're above 132.50, we just need to clear our T-cross long 135.35. And again, once you break above that level, that will confirm probably the final move of dollar strength. But if the dollar is weak, I will point out that in most cases, the Canadian dollar is weak also because of their biggest trading partner. Canada's biggest trading partner is, of course, the US. So either way, this is showing we are building momentum to the upside. We've got an MA diff cross, neural index strength, rising predicted RSI. We just need to clear that T-cross long, and then that should open the door for at least the 136, 137 area. Now, the Aussie and the Kiwi get a boost this past week from the China stimulus, and you can see it's finally pushed above its yearly opening price after multiple tests of that yearly opening. That's coming in at or about the 68.12 area. Now, this is a very good demonstration of that yearly opening price and how important it is not to move it and have random 30 days, random 5 days. No, guys, we need to keep these anchored, right? So each day last week, there was a very good long trade. Despite this stimulus, we still pulled back to our yearly opening price. We're above our T-cross long, but that is your buying area. So this is clearly a long trade while above 68.12. If we lose 68.12, we can reassess that. But for now, any pullback to that area, longs are very reasonable, as clearly displayed in this chart. Now, the only cautionary thing I will say about this pair is, again, that MA diff cross. And once the market digests what's going on in China, that could cool the Aussie off a bit. And if the US stock markets move lower, it could easily drag the Aussie down with the Aussie-US pair down and the Kiwi down with it. But let's reassess and see what we get from this payroll number first. The Kiwi, very, very similar, but you can see it may be a little bit better value buying this pair than the Aussie-US, but it is virtually the same trade. As you can see, it's showing the same signal. So it's not a clear picture on these two. And again, the Aussie was able to push higher, but the Kiwi wasn't above its yearly opening price, only actually closing 1 or 2 days above it here. So that level is 63.11. If we can hold above it, I think we'll have decent longs into year end. We just got to get past the first week of October, and then we can reassess where we're at going into the start of the very important fourth quarter. So with that said, this is the VantagePoint AI Market Outlook for the week of September the 30th, 2024.